Silver, long overshadowed and deeply undervalued for over 160 years, has finally broken through its historic resistance. The charts scream it, the markets confirm it, and the institutions that once defined its artificial price floor are now staring into the abyss. At the center of this storm is the LBMA, the London Bullion Market Association, which finds itself entangled in a liquidity crisis it can no longer paper over. The COMEX, its American counterpart in Chicago, is not faring any better. It can no longer deliver the promised metal. Cash settlements are becoming the new normal. Physical silver? Vanishing. And the panic is no longer theoretical. Banks that were caught on the wrong side of the silver trade, those that were aggressively shorting, are now crumbling under their own leverage. Just yesterday, they collectively tapped the Federal Reserve's repo facility for over $17 billion. That is not a small miscalculation. That is a systemic failure. And this comes as the COMEX raises margin requirements on silver once again, desperately trying to slam the brakes on what has already become an uncontrolled rally. In the past 48 hours, silver shot past $82 per ounce before pulling back slightly, marking one of the most volatile two-day swings in recent metals history. The move has stunned analysts, infuriated short sellers, and emboldened a new generation of physical investors. But the effort to contain it, margin hikes, algorithmic selling, even whisper campaigns is failing. The demand for real, deliverable silver is now louder than the manipulated paper promises that once governed the price. As confidence erodes in these structures, the foundations of institutional control are beginning to crack. And this is just the opening act. For the host of this market earthquake, silver is more than a talking point, it's personal. He's been buying for 8 or 9 years, through the stagnation, through the ridicule, through the claims that silver was dead money. Just last week, at a coin show, he picked up a hefty piece of metal for $67. Today, it's already profitable, not in theory, in cash terms. And that 100-ounce silver bar? It's now worth over $7,500. That's not a prediction. That's a price. The silver price in the United States is inching dangerously close to the $80 mark. More precisely, it's hovering at $79.34. But yesterday, it did something wild. It gained $7.73 in a single day. That's a more than 10% spike. That's not a healthy climb, that's a scream through the roof. As the price surged, something else happened. The gold-silver ratio fell to 57. That ratio, long used as a gauge of relative value between the two metals, now signals a shift. Silver, once treated as a forgotten cousin of gold, is stealing the spotlight. And with that fall in GSR, gold, ironically, becomes a more attractive bet for some, but silver remains the real story. Today, on December 29th, the silver market saw a brief retreat. After peaking at over $82 earlier in the week, prices corrected sharply, dipping to nearly $75 per ounce in Asia. But this wasn't a crash. It was a breathing pause in an otherwise breathless ascent, a market catching its breath before the next leap. And for those still watching from the sidelines, this wasn't a warning sign. It was a second chance. Silver is no longer a niche obsession. It's on the front page, flashing in, bold across the world's financial dashboards. Even Forbes, a publication not exactly known for championing metal bugs, is sounding the alarm. Silver nears $79 amid record-breaking rally. The inertia is gone. Momentum has taken its place. For years, the market capitalization of silver sat buried beneath the glitz of tech stocks and fiat currencies. But now, silver has clawed its way into the number 3 position on the list of top global assets by market cap. And that's not counting entire national currencies, real estate markets, or fossil fuel reserves. In a broader view, when all asset classes are considered, silver has leapfrogged the British pound. One more push, and it could surpass Nvidia. From an industrial commodity to a macro-level player, silver is no longer playing small. And let's be clear, this isn't a fluke. Silver is now up 174% this year. With just days left in the trading calendar, the metal has already outpaced every traditional investment vehicle. Forget the S&P, forget crypto. Silver has become the unexpected champion of 2025. In Germany and across Europe, this surge is fueling a quiet but powerful rotation. As inflation fears persist and energy uncertainties linger, institutional and retail investors are increasingly moving their hedging strategies into physical silver. The shift isn't just speculative, it's defensive. It's generational. And with mounting expectations that the US Federal Reserve will begin cutting interest rates early next year, silver's appeal as a hard asset has never looked shinier. The rally has graduated from YouTube hype to central bank calculation, and the ones who mocked silver's potential are beginning to look suspiciously quiet. The global squeeze is no longer theoretical. China, the world's manufacturing behemoth and one of the largest silver consumers, is now locking its vaults. Beginning on January 1st, new export controls will take effect, requiring special government licenses for all silver leaving its borders. This is not a bureaucratic formality, it is a geopolitical move. It signals that China views silver as a strategic asset worth hoarding. And it comes as no surprise. In Shanghai, silver has already spiked to $85 per ounce, trading at a $5 premium compared to US spot prices. This divergence between the East and West is not just about pricing, it is about control. The LBMA, London's metal exchange, and the global benchmark for silver pricing is on the verge of fracture. Every request to extend silver lease agreements expiring in the next 2 weeks has been denied, regardless of rate. Vaults are being emptied. Extensions refused. This is not a blip, it is a run. Analysts are now quietly admitting what was once unthinkable. The LBMA may soon be forced to reprice silver to match the Shanghai physical benchmark. If it doesn't, it risks a complete systemic default. And while the financial world hesitates, Elon Musk doesn't. The Tesla and SpaceX CEO recently issued a warning about the explosive silver rally, calling it not good. Not for industry, not for production. His worry? That the skyrocketing price of silver will inflate the cost of electric vehicles, solar roofs, and AI infrastructure beyond viability. For once, Musk isn't cheering on the future. He's terrified by its cost. In that light, the next move in silver's price isn't just about traders or coins, it's about factories, semiconductors, and the next wave of global industrial expansion. The question is no longer if silver matters. It's how long we can afford it. While the headlines focus on price, the pressure point lies deeper in logistics. The COMEX, the US-based commodities exchange that underpins global silver futures, is staring down an impossible math problem. Over 63 million ounces of silver are scheduled for delivery in December, but the metal is not there. The warehouses are dry, the exit requests are flooding in, and cash settlement not delivery is becoming the default response. There's no spin left. This is a liquidity shortfall in real time. In response, COMEX is doing what every cornered institution does. It is tightening the screws. Once again, margin requirements have been raised. The cost of holding a silver futures contract has jumped by 13.6%. For gold, it's up 10%. And for platinum, a staggering 23%. It is a clear signal. They're trying to scare the bulls. But the markets are no longer listening. Fresh analysis today shows that these margin hikes have failed to dampen enthusiasm. Instead, they are being interpreted as panic moves by an exchange unable to fulfill its obligations. Meanwhile, inventories at major vaults, both public and private, have fallen to historic lows, adding fuel to the theory that the entire paper-silver system is running on fumes. In any normal market, this would be a 5-alarm fire. In the silver world, it's Tuesday. And so the question hangs. What happens when the contracts come due, and there's nothing but IOUs left? At what point does the illusion crack completely? The answer may arrive sooner than expected. Because the system is not just stretched, it's fraying. And COMEX? It's out of band-aids. The battle lines are drawn. On one side, the bears, the skeptics, the veterans who have seen metals rise and fall for decades. On the other, the bulls, the contrarians, the believers who see silver not just as a commodity, but as a cornerstone of the next industrial wave. Peter Brandt, a name etched deep into trading folklore, declared this week, "This time it will not be different." He has seen 6 different decades of commodity cycles. Every time a supply-demand imbalance emerged, someone always said the same thing, that this time would break the rules. It never did. His point? Gravity always wins. But others are challenging that gravity. Luke Groman, another seasoned analyst, says this rally is categorically different. Back in the 1980s, the Hunt brothers hoarded silver for leverage. Today, silver is being consumed relentlessly by sectors that form the spine of global growth. Electric vehicles, solar, data centers, aerospace. The silver is not sitting in vaults. It's being embedded in technology, vaporized in production lines. It's not coming back. And the charts seem to agree. The 160-year technical chart shows silver has broken out of a multi-generational downtrend. The line has been crossed. The ceiling is shattered. Some now point to upside targets that once sounded delusional, $400, even $1,400 per ounce. But in a world where currency inflation is accelerating and trust in paper is evaporating, those numbers don't sound so crazy anymore. Even the skeptics are quieter. Because deep down, they know this doesn't feel like another spike. It feels like a shift, like the gears of history catching again after decades of slippage. And if they're right, silver's rise isn't just vertical, it's existential. When Elon Musk tweets about silver, it's not a meme, it's a warning. His concern isn't theoretical, it's operational. Silver is a vital component in Tesla's vehicles, solar roofs, rocket systems, and AI infrastructure. A 10% price surge in one day doesn't just shake up investors, it disturbs manufacturing forecasts, cost models, and entire production pipelines. Musk's reaction? This is not good. And he's right. For someone who builds the future, soaring silver prices are a threat to scaling it. The irony is thick. For centuries, silver was the money, the literal coin of the realm. Then it became a barbaric relic. Then a footnote. And now, just as fiat currencies wobble under the weight of endless printing and debt, silver returns to the stage not as money, but as the material backbone of the digital and green revolutions. This week's price action captures that pivot perfectly, starting the week above $82 per ounce. Silver plunged intraday to as low as 75, before bouncing again, a volatility roller coaster that no longer surprises seasoned investors. What does surprise? That over 57% of retail investors now believe silver will surpass $100 per ounce by the end of next year. That belief isn't naive, it's born of watching systems crack. And what about the host of this chaotic ride? He's not trading charts, he's not flipping coins, he's holding bars. For him, silver isn't a quick gain, it's a legacy hedge. A vault of sovereignty in a world of collapsing trust. He doesn't care what silver does on Monday, or even next year. His target? $150 by 2026. Maybe more. Because when silver rises, it doesn't just reflect the market. It reflects the moment we realize the system no longer works.